Imagine waking up in your 30s and realizing that the game of life just turned the difficulty setting to maximum. One moment you are finally enjoying a decent paycheck, and the next you are staring at a massive mortgage application wondering how anyone actually manages to afford being an adult. Your bank account suddenly feels like a financial piñata being pulled in 17 different directions by endless demands. Children need college savings, houses require massive down payments, and retirement accounts are practically screaming for your attention. Most people say your 20s are for figuring things out, but the harsh truth is that by your 30s, you actually need to have everything figured out already. The choices you make during these 10 years will either build a foundation for a comfortable future or leave you desperately playing catch-up for the next 30 years. I want to help you master your money without losing your mind, because navigating this decade should not feel like a constant crisis. Before we break down the key milestones, please understand that this is not about judging where you stand right now. Whether you are already crushing your goals or you are looking at your balance and wondering if you should just give up and become a professional dog walker, these milestones are simply a roadmap for your journey. The first critical money milestone you must achieve in your 30s is the total elimination of all consumer debt. I am talking about reaching absolute zero on everything except for your mortgage. Your credit cards, student loans, car payments, and that random furniture loan from 3 years ago all need to be gone. You might think that paying off massive student loans sounds impossible, but consider the high stakes involved during this stage of your life. Your 30s are your prime earning years, where your salary is likely at its highest point and will probably keep climbing. You cannot afford to let consumer debt act like financial quicksand, dragging down every single dollar you work so hard to earn. If you're sending $400 a month to a credit card company and another $600 to a car lender, that is $1,000 every month that is not building your wealth. Over a single year, that adds up to $12,000, and over a decade, you have handed over $120,000 to someone else. Just imagine what that money could have grown into if you had invested it into your own future instead of making bankers wealthy. This is also the decade where life gets complicated incredibly fast, from growing career responsibilities to raising a family or supporting aging parents. Trying to manage all of these life changes while carrying debt is like trying to ride a unicycle while balancing flaming torches. It might be possible for a few seconds, but it is definitely not a sustainable way to live. I learned this lesson personally when my own father started needing extra help around the house. He is the kind of person who insists on fixing everything himself, which usually leads to a much bigger mess that eventually requires professional help. We recently dealt with a plumbing disaster that he tried to solve with pure willpower, but it only ended up making the situation worse. If I had been drowning in debt payments at the time, I would not have had the cash on hand to simply hire a plumber and solve the problem instantly. The second major milestone is securing an excellent credit score, and I mean reaching 800 or higher. You might think credit scores do not matter if you do not plan on borrowing money, but reality says otherwise for anyone looking to buy a home. Unless you plan to pay cash for your house, your credit score will dictate the total cost of your life for decades to come. Let us look at a $400,000 house as an example. With an excellent credit score, you might qualify for an interest rate of 6.5%, which means you will pay roughly $511,000 in interest over 30 years. However, if your score is just slightly lower, your rate might jump to 7%. That seemingly tiny 0.5% difference means you will pay about $558,000 in interest over the life of the loan. That is nearly $50,000 more for the exact same house just because your credit score was not perfect. Even worse, a single late payment over 30 days can drop your score by as much as 180 points and haunt your report for 7 years. One simple oversight could literally cost you tens of thousands of dollars in extra interest throughout your life. The good news is that keeping an excellent score is simple if you pay every bill on time, keep your credit usage below 10%, and avoid closing old accounts. The third milestone is creating a comprehensive financial plan that covers the next 30 years of your life. I know that planning 30 years ahead sounds about as fun as a root canal, but without a strategy, you are just playing a game of financial whack-a-mole. I like to use a simple system to keep everything organized. You need a clear budget to know exactly how much you are saving and a retirement plan to ensure you are actually on track to stop working one day. You also need estate planning, which is essential if you have children, and tax planning to make sure you keep as much of your income as legally possible. If you are finding these tips valuable and want to truly transform your financial future, make sure to subscribe to Billy Finance and join our community of wealth builders. This might also be the stage of life where hiring a professional financial planner makes sense to help you see the big picture. Finally, The fourth milestone is building a bulletproof emergency fund. While the old advice was to save 3 to 6 months of expenses in your 30s, you need to aim for 6 to 12 months instead. This decade brings bigger risks, such as a failing water heater, emergency dental work for the kids, or helping parents with unexpected medical bills. Having a massive cash cushion allows you to take calculated risks and negotiate from a position of power in your career. High-yield savings accounts are the perfect place to keep this money so it stays accessible while still earning a bit of interest. The fifth financial milestone you should aim for is having 3 times your annual salary saved for retirement by the age of 40. Current data suggests that the average income for a 40-year-old in the United States is approximately $62,000. This means your target retirement savings should be roughly $186,000 by the time you reach that decade mark. Before you start to worry about your progress, let us look at the long-term perspective. If you have that amount at age 40 and continue to contribute consistently, retirement projections show you could have over $2 million by the time you reach 67. That is the incredible power of compound interest working in your favor, but it only performs its magic if you give it enough time. What truly matters here is giving compound interest decades to grow, as having a substantial balance early on allows your money to do the heavy lifting. Every year you delay serious retirement saving is a year of potential growth that you are giving up forever. If you find yourself behind on this goal, do not despair, but you must get serious about catching up right now. You still have 25 to 30 years until retirement, which is plenty of time for growth, but the mathematical challenge increases every single year you wait. If you find yourself lagging, consider increasing your contributions every time you receive a raise, a bonus, or switch to a better-paying job. The difference between saving 10% of your income versus 15% might seem minor today, but over 25 years, it determines whether you retire in comfort or work until you're 75. The sixth milestone is achieving what I call lifestyle inflation immunity, which separates true wealth builders from those who are just pretending. Your 30s are the prime season for lifestyle creep, where your expenses rise just as fast as your income. You get a promotion and suddenly feel you deserve a more expensive apartment or a luxury vehicle. Your income goes up, and somehow your spending magically rises to meet it, leaving you with the same amount of savings you had when you were earning much less. It is common to see people making 6 figures who are perpetually broke because they are financing $70,000 cars and eating out every single night. It is like watching someone pour water into a bucket with holes in the bottom and wondering why it never fills up. Your secret weapon against this trend is a combination of automation and awareness. Every time your income increases, automatically direct at least half of that raise toward your savings and investments before your brain finds new ways to spend it. If you receive a $5,000 raise, immediately set your accounts to invest $2,500 of that annually. Your future self will be incredibly grateful, and your current self will not even miss the money you never had the chance to waste. The seventh milestone might seem a bit heavy, but it is actually one of the most responsible things you can do for your loved ones. You need to get your estate planning sorted out. You might think you are too young for this, but if you have children, a mortgage, or any significant assets, you need basic legal documents in place. This is not just about planning for the end. It is about preparing for life's unexpected turns. If an accident leaves you unable to make decisions, you need to know who will care for your children and manage your property. Without proper documentation, these critical life decisions are made by courts and bureaucrats instead of by you. The good news is that basic estate planning is much simpler and more affordable than most people realize. You can start with simple online tools for basic wills and powers of attorney to ensure you have a foundation. The eighth milestone is one that financial experts rarely mention, but it might be the most vital of all: investing in your health. Your health is your greatest financial asset, and your 30s are when you either build that asset or start watching it depreciate. Look at it through a mathematical lens. The average American spends over $300,000 on healthcare throughout their life. If you can reduce that by even 20% through preventive care, better nutrition, and regular exercise, you have effectively saved yourself $60,000. This does not even account for the income you keep by avoiding sick days or the career opportunities you can seize because you actually feel energized. Your 30s are often when your metabolism begins to slow down and habits become harder to change. Developing healthy routines now while you still have physical flexibility is much easier than trying to reverse decades of neglect when you're 50. This does not mean you need to become a professional athlete. It simply means finding sustainable ways to move, eating nourishing food, and managing stress. The money you spend on a gym membership or quality food is a drop in the ocean compared to the cost of treating preventable chronic illnesses later. The ninth milestone involves thinking seriously about education savings if you have or plan to have children. College costs have been rising at twice the rate of inflation for 3 decades, and a 4-year degree can now cost between $40,000 and $70,000 per year. Starting early allows compound interest to work for your children, just as it works for your retirement. A 529 education savings plan is a powerful tool for this, offering tax advantages that significantly boost your growth. The money in these accounts grows tax-free, and as long as it is used for qualified education expenses, you pay no taxes on the withdrawals. Even saving a modest $50 or $100 a month starting when a child is young gives that money nearly 2 decades to multiply. The 10th and final milestone for your 30s is developing true financial confidence. This is not about reaching a specific net worth, but about understanding your finances well enough to make decisions without constant anxiety. Financial confidence comes from having systems in place and knowing you can handle whatever challenges the economy throws at you. It means you are no longer lying awake at 3 in the morning wondering if you can afford your lifestyle or your future. This is the stage where a comprehensive financial plan becomes a necessity rather than just a suggestion. You need to see how your emergency fund, retirement, education savings, and insurance all work together as a single cohesive strategy. It is vital to have a professional who can look at the big picture and offer unbiased guidance when your emotions begin to influence your choices. The secret is maintaining a strategy that you fully comprehend and trust. This plan needs to evolve alongside your life while giving you the certainty that you are moving toward your future objectives. This is especially important during those times when market fluctuations make it feel like you are losing ground. Your 30s represent your ultimate financial peak. At this stage, you are likely making more money than ever before in your life. You still have several decades for the power of compound interest to perform its wonders. However, you are also facing more financial obligations and conflicting priorities than you ever have in the past. The choices you commit to during this 10-year period will define whether your 50s and 60s are filled with stress or with the rewards of your hard work. Your 30s do not have to feel like a financial horror story where everything goes wrong. These 10 milestones are not designed to stress you out or make you feel like you are failing some invisible race. Instead, they are here to provide a clear path so you can actually appreciate your 40s and beyond. You want to live without the constant fear of whether you can retire or if you will be stuck working until you're 85. The great advantage of being in your 30s is that there is still plenty of time to fix your direction if you feel behind. Of course, starting earlier would have been better, but dwelling on past mistakes is as useless as trying to drive a car while staring only at the rearview mirror. Simply select 1 or 2 of these goals that feel most relevant to your life right now and take that first step. Perhaps it is time to finally eliminate that credit card debt or open that high-yield savings account you have been putting off for 6 months. Remember that small and consistent efforts build up over time, just like your financial investments do. Thank you for watching, and do not forget to subscribe to Billy Finance for more wealth-building strategies. We would love to hear your thoughts, so please leave a comment down below and tell us which milestone you are attacking first. Goodbye, and we will see you in the next video.